Global bonds, equities and commodities recovered some of their recent losses, and the dollar rally eased due to comments by the US and because China's central bankers eased concerns about liquidity conditions. I have Orlando Green on the line to discuss his views on the trends we are currently witnessing in global government bonds. Hi Orlando, so can you walk us through the impact these comments are having on the global bond market?
Well, really, the thoughts from last week is certainly a perception of a repricing in the sort of Fed's monetary policy cycle, and there seems to be, if you like, a fear that the Fed will be tightening sooner than what the market had assumed. So that seems to be really what the impression that you get from what looking at the bonds and equity markets, really, that liquidity will be it will no longer be taken for granted, and then we're going to see higher rates in as a result of straight on the back of that. But from our perspective, we're seeing the market maybe jumping the gun to some degree. Clearly, the reprice, we've always thought that sometime we thought that the bond yields were excessively low, but nonetheless, so some element of repricing is warranted from our perspective if you look at how the economy has been behaving. But then the pace of the move would suggest that the market is repricing, that the Fed will potentially hike us sooner than was thought maybe a month or so ago. So we don't think that's necessarily the case. The taper is certainly they'll move one step at a time, and they will certainly not rush into hiking rates until they really do think the economic recovery is sustainable.
And if you look more closely at US Treasuries, 30-year US Treasuries turned positive yesterday, rising to session highs. Now, in terms of prices for 10 and 30-year Treasuries, what are you expecting to see?
We think that certainly there's potential for things to continue over the medium term. Clearly, we may get some intermittent movement, in either direction for the time being until the market catches its breath. But no doubt that the data over the coming days and weeks ahead will really be highly sensitive for interest rate markets, and clearly the jobs report next week could potentially be a trend setter if we do continue on the path that we have been on recently. Now, we've been looking for something in the region of yields in the region of moving towards 3%, probably more so going into next year. So we have a year-end target of 285 in terms of 10-year T-notes. So this is something that it was very much an aggressive call only a week or so ago, but the market is essentially not a million miles away from that now. So this is something that we do think can continue, and we think it's justified more so when you look at the macro fundamentals, but also something that we've looked at and we've observed over the past year or so is the sort of supply-demand imbalances of the Treasury market, where there's still the supply that's been very much run at a heavy rate, at a large volume, albeit at a slightly lower level than it has been in the past. But nonetheless, demand has fallen away in some areas. Official flows, if you look at Asia flows, from central banks, is diminished somewhat. If you look at some of the TICS data as well, there's been some areas which have been heavy buys of Treasuries. They've curtailed their holdings, and the banking data as well has shown that Treasury holdings has been diminished. So there's certainly less demand for Treasuries that we've observed anyway over the past year than there has been earlier on during the crisis.
And finally, looking at the European market now, German bonds rose for the first time in 4 days. What type of trends are you anticipating? Yeah,
we're still saying high yields in terms, but it's going to be a gradual thing. For one, we do think the US yields will certainly be leading the way. So we do have we do look for a steady, quite a marked increase in US yields, 10-year yield, like we said, going up through 3% going into next year, and to some degree, German yields will follow suit. We don't think sovereign tail risk is. We do expect sovereign tail risk to remain minimal, as it has done over the past, since the midway through last year. So some yields should rise, but in a gradual manner. And again, we're looking at around 280 by. Sorry, not 280. Yeah, 190. Beg your pardon. By year end, which clearly the market is only a gradual move, and then we're looking towards 2% going into the first quarter of next year. So more than a trend Q1 next year rather. So there's certainly there's scope to rise in terms of German yields, but it's going to happen in a gradual manner, given the fact that the US cycle is a lot further ahead than the Eurozone cycle, including Germany. But there should be better growth numbers coming out from Germany, France, among others, and we should have less of an economic contraction from some of the periphery as well.
Thank you very much, Orlando, for sharing your expertise with us today. Well, viewers, that is it for right now. But do stay tuned to have a look at Natalie MacDonald's interview on Hungary's rate decision. But for now, have a great day.